Welcome back. For our explainer on November 25th, 2025, we saw a market that was getting pulled in two completely different directions. It was a massive tug of war. You had a huge shock in the world of AI on one side, and on the other, some very powerful whispers coming from the Federal Reserve. So let's break down who actually won the day. Now, if you just looked at the closing numbers, you'd think everything was fantastic. I mean, the S&P 500 up nearly 1%, the Nasdaq gaining ground, and the Dow, wow, surging over 1.4%. On the surface, it was just a sea of green, pure optimism, right? Well, whenever you see numbers this strong, you have to ask yourself, what's the real story hiding underneath? Because on this particular day, those positive headlines were actually masking a really fierce battle between two totally different market narratives. Okay, let's get into the first major force, and it was a big one. We saw a potential changing of the guard in the AI universe, and that acted as a major headwind for the whole tech sector. So here's the bombshell that dropped. Reports started swirling that Meta is seriously thinking about using Google's own custom TPU chips for its infrastructure. Now, TPUs are tensor processing units. They're chips Google designed specifically for AI. And this is a huge deal because for the very first time, NVIDIA, the undisputed king of AI chips, is facing a credible, large-scale challenge to its throne. And you better believe that sent shockwaves through the entire space. And this slide just perfectly illustrates the impact. Look at that. While NVIDIA only closed down about 2.5%, at its worst point during the day, it had plunged a staggering 7%. That kind of wild swing just shows you how nervous the market is about any threat to the current AI hierarchy. You know, this take from Morgan Stanley really sums it all up. The days of just buying any stock that has AI in the name, those are over. The market is getting way smarter, much more selective. It's starting to ask the tough questions about who is actually going to profit from all this. So with all that drama, you'd think the tech-heavy market would have been pulled down hard. But it wasn't. So why not? Because an even bigger story was playing out, creating this powerful tailwind for everybody else. And that was the growing belief that the Fed is about to pivot. It all happened in a few key steps. First off, we got a pretty weak jobs report from ADP, which suggests the labor market is cooling down faster than we thought. Then, news broke that Kevin Hassett, who is a well-known dove that really favors rate cuts, is a top candidate for the next Fed chair. You put those two things together, and suddenly, market expectations for a change in policy just went into overdrive. And just look at how certain the market became. It's incredible. Traders immediately priced in an 83% chance of a rate cut as soon as next month, in December. That is an unbelievably strong signal that the market thinks lower rates are right around the corner. So this brings us to the real heart of the day's story. How in the world did this broad macroeconomic hope for lower interest rates manage to completely overpower the very specific, very real microeconomic fear that was shaking up the tech sector? And the thing is, this wasn't just a feeling. You could see it in the data across the entire financial system. The 10-year Treasury yield fell, which makes borrowing cheaper for everyone. The dollar got weaker, which helps U.S. companies that sell stuff overseas. And the VIX, the market's fear gauge, it dropped almost 7%. All the signs were pointing to a massive risk-on mood. We also saw this shift playing out inside the S&P 500 itself. Money started to rotate. The day's biggest winner wasn't some high-flying tech name. It was the defensive healthcare sector, jumping over 2%. This tells you that even with all the optimism, investors were still looking for a bit of stability. And this is so key. It wasn't just a handful of giant stocks pulling the market up. The Russell 2000 index, which tracks smaller companies, surged over 2%. We call that a broadening rally, and it's a really healthy sign that the optimism is spreading to all corners of the economy, not just the big guys. So what on earth are you supposed to do in a market that's being pulled in two different directions like this? Let's quickly walk through two potential strategies that kind of pop out from a day like today. You really have two clear paths here. The aggressive strategy says, nope, the AI story is still the most important thing, so I'm going to lean in, but I have to be careful and pick the new winners. The stable strategy says, the bigger story is the broad market rally, so I'm going to diversify away from all that tech volatility and focus on value. Okay, so with the aggressive playbook, the biggest risk is pretty obvious. You could pick the wrong horse in this AI race. So to manage that risk, you could use an ETF like QQQ for broad exposure to the big tech leaders, or something like the SMH Semiconductor ETF to just bet on the entire AI chip ecosystem instead of one single company. Now, for the stable approach, the main risk is that the market just got a little too excited and the Fed ends up disappointing everyone. To play this theme, you could look at XLV to ride that wave into defensive healthcare. Or you could use an equal weight ETF like RSP, which is a great way to benefit from a broad market rally without being too exposed to just a few mega cap tech stocks. And that really leaves us with the big question as we move forward. Was today the beginning of a truly healthy, sustainable rally that's fueled by the Fed and is spreading across the entire market? Or was that tremor we felt in the AI space just a warning shot, a sign that the sector that has led us this far is about to hit some serious turbulence? The answer to that is probably going to define where we go from here.